Hi there. In this video, we're going to dive deep into three critical metrics for understanding a company's financial health. Specifically, we'll be looking at DSO or Days Sales Outstanding, DIO or Days Inventory Outstanding, and DPO or Days Payable Outstanding. We'll also explore how these metrics relate to the operating cycle and, most importantly, the cash conversion cycle. Understanding these metrics is crucial for anyone involved in finance, accounting, or generally business management. Whether you're an entrepreneur, an investor, or simply looking to gain a better understanding of how businesses manage their cash flow, you're in the right place. Let's begin with Days Sales Outstanding or DSO. You might also hear this referred to as Days Receivables Outstanding or DRO, or even the average collection period. Essentially, regardless of the name, DSO tells us the average number of days it takes a company to collect payment after making a sale. Here we have a basic illustration. Imagine a company makes a sale on day N. This is the point where the goods or services are delivered and an invoice is issued to the customer. Okay. Now the customer doesn't pay immediately. In this example, it takes them 10 days to settle the invoice. Okay, so we receive the cash on day N plus 10. Okay. This 10-day period is the DSO in this scenario. Okay, it's the time gap between making the sale and receiving the cash. Okay, a lower DSO generally indicates that a company is collecting its receivables quickly, which is a very good sign. A higher DSO, on the other hand, might suggest potential issues with the company's credit policy or collection process. Okay, we'll look deeper into the calculation and implications of DSO in the upcoming slides. Now that we understand what DSO represents, let's talk about how we calculate it using financial statements. To calculate DSO, we need two key pieces of information: average receivables and annual sales revenue. You might wonder why we use the average receivables. The reason is that receivables fluctuate throughout the year. Imagine a company that makes most of its sales during the holiday season. Their receivables will be much higher towards the end of the year as compared to the first few months of the year. Okay, to get a representative figure, we take the average of the receivables at the beginning of the year, which is technically at the end of the previous year, and along with the end of the current year. Okay, we take the average of these two. In any ratio that involves metrics from both the income statement and the balance sheet, it's generally a good practice to average the balance sheet metric with the end of the previous year. This provides a reasonable proxy for the average balance throughout the year, as balance sheet figures are snapshots in time. A crucial point to clarify is what we mean by sales revenue in this context. Ideally, for DSO calculations, we should be focusing on credit sales only. Okay, this is because DSO measures how long it takes to collect on outstanding receivables which are generated from sales made on credit. Okay. However, in practice, many companies, especially those with a large volume of cash sales, might use total revenue just for simplicity. Okay, this can include customers who pay immediately. While this approach might slightly skew the DSO figure, it often simplifies the calculations and still provides a useful general indication of collection efficiency. This slide shows the sales for the year, and the curved arrows represent the cycles of sales and collections. Okay, think of it this way. If a company's annual sales are 6 times their average receivables, it means they've collected their receivables 6 times during the year. This is called receivables turnover. Why is this important? Receivables turnover is related to DSO. If a company collects its receivables more frequently, its DSO would be lower. Okay, we'll see how these two metrics are connected when we look at the formula for calculating DSO in the next slide. Now let's look at a concrete example. Here we see a snapshot of a company's financial data. From the balance sheet, we have the accounts receivable at the end of the previous year, year N, which is 90. Okay, at the end of the current year, which is year N plus 1, it's 110. Okay, we calculate the average by adding these two values and dividing by 2, giving us an average accounts receivable of 100. Okay, from the profit and loss statement or the P&L, we have the revenue for year N plus 1, which is the current year, which is 1,200. Okay, now let's calculate DSO. First, we calculate receivables turnover. As we discussed earlier, receivable turnover is calculated by dividing revenue by average receivables. Okay, in this case, 1200 divided by 100, which equals 12. Okay, DSO is then calculated by dividing the number of days in the period, which is 365 for a year, by the receivables turnover. So 365 divided by 12 gives us a DSO of approximately 30 days. Okay. Alternatively, we can calculate DSO directly by using average receivables and revenue as shown by the formula here. Okay. So on average, it takes this company about 30 days to collect payment from its customers after making a sale. Finally, let's explore a more logical way to interpret DSO, which is particularly useful for forecasting. Here we see that revenue represents 365 days of sales. Okay. If we then consider that average receivables represent an unknown number of days, this unknown number of days is essentially our DSO. Okay. In other words, the average receivables or the result of the number of days worth of sales that are still outstanding. This relationship can be expressed algebraically as shown in the formula at the bottom here. Revenue divided by 365 should equal to average receivables divided by the DSO. Think of it this way. If your total yearly sales represent 365 days of sales activity, then your average receivables represent a certain number of those days, which is your DSO. Okay. Why is this useful? This interpretation is particularly helpful when forecasting. Okay. If you have a forecasted revenue figure, perhaps based on a revenue growth percentage, okay, and you have a target or historical DSO, you can easily calculate the forecasted average receivables. This allows you to project your working capital needs and manage your cash flow more effectively. This logical understanding of DSO provides a powerful tool for financial analysis and planning. Now let's move on to Days Inventory Outstanding or DIO. You might also hear this referred to as Days Sales of Inventory or DSI, or inventory days, or days in inventory, or the average age of inventory. Essentially, regardless of the name, DIO tells us the average number of days a company holds its inventory before selling it. Okay, here we have a basic illustration. Imagine a company purchases inventory on day N. Okay, this is the point where the company acquires the goods or materials. Now the inventory doesn't sell immediately, right? In this example, it takes them 10 days for the inventory to be sold. So the sale occurs on day N plus 10. Okay, this 10-day period is the DIO in this scenario, right? It's the time gap between purchasing the inventory and selling it. A lower DIO generally indicates that a company is selling its inventory very quickly, which is a good sign. A higher DIO, on the other hand, might suggest potential issues with the inventory management, such as overstocking or slow-moving items. Okay, we'll explore deeper into the calculations and implications of DIO in the upcoming slides. Now that we understand what DIO represents, let's talk about how we calculate it using data from financial statements. To calculate DIO, we need two key pieces of information. Okay, average inventory and cost of goods sold or COGS. Okay, why average inventory? Just like with receivables, inventory levels fluctuate throughout the year. Okay, for example, a retailer might stock up heavily for the holiday season. Okay, to get a representative figure, we take the average of the inventory at the beginning of the year, which is technically the end of the previous year, along with the end of the current year. Okay, then why cost of goods sold? You might wonder why we use COGS here instead of revenue when calculating DIO. COGS represents the direct costs attributable to the production of the goods sold by a company. It reflects the cost of inventory that has been sold during that period. Okay, since DIO measures how long it takes to sell inventory, COGS provides a more accurate representation of the inventory that has moved through the company. Revenue, on the other hand, reflects the selling price, which includes a markup. Okay, this slide shows the COGS for a year, and the curved arrows represent the cycles of inventory purchase and sale. Think of it this way. If a company's annual COGS is, say, 6 times their average inventory, it means they've sold their inventory 6 times during the year. Okay, this is called inventory turnover. Why is this important? Because inventory turnover is directly related to DIO. If a company sells its inventory more frequently, its DIO will be lower. We'll see how these two metrics are connected when we look at the formula for calculating DIO in the next slide. Here we see a snapshot of a company's financial data. From the balance sheet, we have the inventory at the end of the previous year, which is 90, and at the end of the current year, which is 110. Okay, we calculate the average to be 100. From the profit and loss statement, or P&L, we have the cost of goods sold for the current year to be 1,200. First, we can calculate the inventory turnover. As we discussed, inventory turnover is calculated by dividing COGS by average inventory. Okay, in this case, 1,200 by 100 is 12. Okay, DIO is then calculated by dividing the number of days in the period, which is 365 here, by the inventory turnover. Okay, so 365 by 12 is approximately 30 days. Okay, alternatively, we can also calculate DIO directly as shown by the formula here. So on average, it takes this company about 30 days to sell its inventory. Finally, let's explore a logical way to interpret DIO, which like DSO is particularly useful for forecasting purposes. Here we can see that if COGS represents 365 days of inventory usage, we can then consider average inventory represents an unknown number of days. This unknown number of days is essentially our DIO. In other words, the average inventory on hand represents the number of days worth of COGS. This relationship can be expressed algebraically as shown here. Okay, COGS divided by 365 should be equal to average inventory divided by DIO. Think of it this way. If your total yearly COGS represents 365 days of inventory usage, then your average inventory represents a certain number of those days, which is your DIO. Why is this useful? This interpretation is particularly helpful when you forecast figures. If you have a forecasted COGS figure, perhaps based on sales projections or production plans, and you also have a target or historical DIO, you can easily calculate the forecasted average inventory. This allows you to project your inventory needs and manage your working capital very effectively. This logical understanding of DIO provides a powerful tool for inventory management and also financial planning. Okay, finally, let's move on to Days Payable Outstanding or DPO. You might also hear this referred to as average payment period. Essentially, regardless of the name, DPO tells us the average number of days a company takes to pay its suppliers. Okay, here we have a basic illustration. If a company purchases inventory on day N, this is the point where the company receives the goods or materials and incurs a liability to its supplier. Now the company, because it doesn't pay immediately, okay, in this example, it takes 10 days for the company to pay its supplier. So the payment occurs on day N plus 10. Okay, this 10-day period is the DPO in this scenario. It's the time gap between purchasing the inventory and paying for it. A higher DPO generally indicates that a company is taking longer to pay its suppliers, which can be a sign of good cash management, but also potentially a sign of financial distress if it's excessively high. A lower DPO, on the other hand, means the company is paying its suppliers quickly. We'll get deeper into the calculation on implications of DPO in the upcoming slides. Now that we understand what DPO represents, let's talk about how we can calculate it using data from financial statements. To calculate DPO, we need two key pieces of information: average payables and purchases. Okay, why average payables? Just like we've seen with receivables and inventory, payables fluctuate throughout the year. To get a representative figure, we take the average of the payables at the beginning of the year, which is technically the end of the previous year, along with the end of the current year. Okay, why COGS or other expenses? For many companies, especially those involved in manufacturing or retail, COGS is used as a proxy for purchases. This is because COGS represents the direct cost of goods that were purchased and then sold during the period. It's often difficult to directly find the purchases figure on financial statements, but COGS provides a close approximation here. However, for some service-based companies or companies with significant operating expenses beyond inventory, using only COGS might not be accurate. These companies might include relevant SG&A expenses, which is selling, general, and administrative expenses, in their DPO calculation. For example, a consulting firm might include expenses related to outsourced services or software subscriptions. It's crucial to be consistent and transparent about which costs are included in the DPO calculation. This slide shows the COGS for the year and the curved arrows represent the cycles of purchases and payments. Okay, think of it this way. If a company's annual COGS is say 6 times their average payables, okay, it means they've paid their suppliers 6 times during the year. Okay, this is called payables turnover. Okay, why is this important? Payables turnover is directly related to DPO. Okay, if a company pays its suppliers less frequently, its DPO will be higher. We'll see how these two metrics are connected when we look at the formula for calculating DPO in the next slide. Now let's look at a concrete example for DPO. Okay, here we see a snapshot of a company's financial data. From the balance sheet, we have the accounts payable at the end of the previous year, which is 90, okay, and at the end of the current year, which is 110. Okay, we calculate the average as 100, okay. From the P&L or profit and loss statement, okay, we get the cost of goods sold to be 1,200, okay. First, we can calculate the payable turnover. As we discussed, payable turnover is calculated by dividing COGS by average payables. In this case, 1,200 over 100 is 12. Then DPO is calculated by dividing the number of days in the period, which is 365 for a year, by the payable turnover. Okay, so 365 over 12 is approximately 30 days. Okay, alternatively, we can use a direct formula to calculate DPO using the average payables and COGS. Okay, so on average, it takes this company about 30 days to pay its suppliers. Finally, let's explore a more logical way to interpret DPO, which like DSO and DIO can be useful for forecasting numbers. Okay, here we see that COGS represents 365 days of purchases. If we then consider that average payables represent an unknown number of days, this unknown number of days is essentially our DPO. Okay, in other words, the average payables represent the number of days worth of purchases that are still outstanding. This relationship can be expressed algebraically as shown here. COGS divided by 365 should equal to average payables divided by DPO. Think of it this way. If your total yearly COGS represents 365 days of purchases, then your average payables represent a certain number of those days, which is your DPO. Why is this useful? Again, it has something to do with forecasting, right? If you have a forecasted COGS figure, perhaps based on sales projections, and you have a target or historical DPO, you can easily calculate the forecasted average payables. Okay, this allows you to project your cash outflows and manage your working capital very effectively. Okay, this logical understanding of DPO provides a powerful tool for financial analysis and planning. Now that we've examined DSO, DIO, and DPO individually, let's take a moment to compare them side by side. This will help us solidify our understanding of their differences and how they fit together. Okay, here we have a table summarizing the key aspects of each metric. Okay, as you can see, while each metric is calculated similarly, they measure very different aspects of a company's operating cycle. DSO focuses solely on how quickly a company collects cash from its customers. Okay, DIO focuses on how quickly a company sells its inventory, and DPO focuses on how quickly a company pays its suppliers. It's also important to note the impact of an increase in each metric and the ideal trend. Okay, for DSO and DIO, a lower number is generally better, as it indicates greater efficiency in collecting cash and selling inventory respectively. Okay, but for DPO, a higher number is generally better, as it means that the company is taking longer to pay its suppliers, which can free up cash in the short run. Okay, however, an excessively high DPO can strain relationships with suppliers. By understanding these differences and similarities, we can gain a more comprehensive view of a company's cash flow and operating efficiency. Now that we have a good understanding of DSO, DIO, and DPO, we can combine them to understand two important concepts: the operating cycle and the cash conversion cycle. The operating cycle is the total time it takes for a company to convert its inventory into cash. It's calculated by adding the days inventory outstanding and the days sales outstanding. Okay, so DIO plus DSO. This represents the time from when inventory is purchased to when cash is collected from the sale of that inventory. In other words, it measures how long a company's cash is tied up in inventory and receivables. Okay, the cash conversion cycle, also known as the net operating cycle, measures how long a company needs to finance its operations. It's calculated by adding days inventory outstanding and days sales outstanding and then subtracting the days payables outstanding. Okay, so DIO plus DSO minus DPO. The cash conversion cycle takes into account the fact that a company gets credit from its suppliers, which reduces the time it needs to finance its operations. A shorter cash conversion cycle, or CCC, means that a company can quickly convert its investments in inventory and other resources into cash, and a longer CCC means that funds are tied up for a more extended period. In essence, the operating cycle tells you how long it takes to sell inventory and collect the cash. The cash conversion cycle tells you how long the company needs to finance that process. A shorter cash conversion cycle is generally better because it frees up cash for other purposes. Alright, thank you so much for watching. I hope you found this explanation helpful and informative. I'd like to invite you to check out my comprehensive 12-part free course on financial accounting available right here on YouTube. The link to this course is provided below and in the video description. This course covers a wide range of financial accounting topics in detail, and it's a great way to build a solid foundation in the subject. And finally, if you want to expand your knowledge of accounting, finance, economics, math, statistics, and other related areas, I invite you to subscribe to my channel. You can also visit my website joefacet.com for additional resources and materials. Thank you again for your time, and I hope to see you in future videos or on my website. Cheers.